This is $150 trillion in Zimbabwe currency, and I hope our governments don't make the same mistake, because right now, even this black and white $115 trillion note in the Zimbabwe currency probably isn't even worth the print that I just did, even in black and white. Currently, right now, the government is handing out free money by lowering interest rates and promoting spending in the economy. Right now, we're in the beginning of a new phase known as quantitative easing. If you try Googling quantitative easing, you'll see that there's a full-on description and it doesn't make quite as much sense. But in layman's terms, what essentially quantitative easing means is that the government is using debt to pay off debt. Are you confused? Because I certainly am. Just before I begin with the video, my name is Mihir and welcome to my YouTube channel. In this channel, I upload educational content such as this twice a week, but now I'm aiming for 3. So if you're interested in content such as this, please hit like and subscribe, as this really helps me out. Without further ado, let's get straight into the video. In the short term, in theory, this should stimulate a growth in our economy as the Fed and the government are injecting more money into the market. You can think of this as like an oil to a car. Without the oil, the car won't work. The primary way governments go about quantitative easing is by lowering the interest rate. And what happens with that is, in theory, if you lower interest rates, the value of the assets should rise. And that's because if more people are able to borrow more money, that increases the competition, which indirectly boosts the value of the asset. The stock market also does well, as corporate debt is being bought by the Reserve Bank. So in a nutshell, this means they are printing more money to increase spending in the economy. The central banks use the newly printed money to purchase assets. This is an activity that's done by them usually. However, during times such as these, it's the scale and the type of assets they buy which makes quantitative easing so unconventional and controversial. So now you may be wondering, well, Mihir, how do interest rates actually get lowered? The way that happens is because, you can think of it this way, there's a hierarchical structure between banks. The central bank comes at the top, then comes the other banks. The other banks, such as ANZ, Westpac, Commonwealth, they essentially borrow from the central bank or the Reserve Bank of Australia. And as the Reserve Bank of Australia has printed more money, those other banks have additional cash. In theory, rather than just letting it sit there, those banks will give it back to the consumer. So a lender can borrow more money, and eventually this causes a chain reaction, as you have a plethora of banks doing the same thing. And since all of the banks are doing this, the only way to remain competitive is to offer lower interest rates so they attract clients and customers. A key example of this is when the Commonwealth Bank of Australia lowered the interest rate to 0.25%. And this was before the emergency meeting that occurred in March, when the Reserve Bank of Australia decreased it to 0.25. This really all sounds good in theory, however there are some drawbacks that come with it. The first drawback is that this can cause inflation. And inflation is naturally always occurring, however this can speed it up. And if it does that, it's also known as stagflation, which is another word for hyperinflation. You can think of inflation as the cost of living. So if anything you earn is below inflation, or let's just say your interest rates are below inflation, you are essentially losing money. The best way to visualize this is with a dollar note in the 1950s. A $5 note would be worth a lot more than it is today. Alright? A note doesn't really have as much value as you think it does, because the feds, they can just print out more and more money, just like the Zimbabwe dollar I have here. It's $150 trillion. So yeah, that's what happens. Now you may be thinking, is this truly effective? So what I'm going to do is we're going to dive back straight into history. In 1997, Japan fell into an economical crisis, and within the 2000s, the Japanese government was aggressively pushing quantitative easing. So what happened was, this turned out to be a major flop. The GDP of Japan, the gross domestic product, which essentially is an indicator of a country's wealth, fell from $5.45 trillion to $4.52 trillion. Japan basically lost $1 trillion. Another example I can give you is the Swiss bank, when they employed this strategy after the 2008 crisis. However, many economists are still arguing as to whether this had a positive, substantial growth to the economy or not. There isn't a clear-cut answer, which you might have been looking for, because I presented you examples with Japan where it's done bad, whereas Swiss, it's actually done good, but they're not sure if that was the actual contributor. And I've also showed you Mr. Zimbabwe, which is now $150 note, but it's not even worth the value of $1 Australian dollar. So most of you will probably be worried and you're probably thinking right now, what's going to happen? But I want you guys to be rest assured, Australia has some of the toughest and the strictest lending policies in the world. We're not like America, where we sometimes just lend out a lot of money without having much verification and a lot of checks. Hence why we haven't had any issues for the past 30 years. So I suggest you guys just calm down. We're gonna bounce back. It'll be alright. If you enjoyed this video, please hit like and hit subscribe. My goal is to reach 1,000 subscribers this year, and I can't do it without you guys. So if you enjoy this content, please feel free to subscribe. Or if you would like to ask specific questions, leave them in the comment box below and I can make a video on that. Besides that, I hope you have a beautiful day. Goodbye.